Welcome to our sponsor Q&A. I'm Daniel Brereton, Director of Investor Relations here at EquityMultiple. Today we'll be discussing 799 Manhattan Avenue, a multifamily and mixed-use building in Greenpoint, Brooklyn. I'm joined today by Peak Capital Advisors, the sponsor on that property. They're a new sponsor that we're working with. We're really excited to be joined with them today. We'll have Alex Rabin and David Gomez here, co-founders of Peak, along with Alex Caskell, a partner of asset management and investor relations at Peak. Alex, David, and other Alex, really happy to have you here.
Glad to be here.
Thanks for having us.
As a new sponsor that we're excited to be working with, can you just briefly tell us about Peak, how you all joined, and how you guys got started?
So I can go into the background. We really started the company with a focus on Western Queens. David and I met several years back in 2018. And David was an investment sales broker. I was working in real estate private equity. We both, were young entrepreneurs. David had, recently just bought 39 Spring Street. I was very active in acquisitions on the institutional side. And, we wanted to do something on our own. And, we found an opportunity in Sunnyside, Queens, which we thought was very interesting. It was 6 apartments and 3 stores, a corner building, 1 block off the 7 train, which was, roughly about 20 minutes from Grand Central. And what we really liked about that submarket was a few things. One, we just thought it was an interesting pricing arbitrage to Brooklyn. We saw a ton of operators that were chasing neighborhoods like, Williamsburg, Greenpoint, Park Slope, Brooklyn Heights, Cobble Hill, and paying astronomical prices to, kind of go to these markets that were really rapidly growing. But not many institutional players were focused on Queens. So, one, we liked the pricing arbitrage, which was roughly 30 to 40% cheaper than those markets. And you still, had a neighborhood that was within 20 to 25 minutes of public transportation, by the 7 train, or neighborhoods of Astoria, by the yellow lines to Midtown Manhattan. And these were, good middle-class neighborhoods, a lot of restaurants and bars and kind of nightlife, and, low crime, clean areas. And that was really interesting to us. Also, what we really liked was there was a lack of institutional walk-up supply. So you had kind of, your ground-up buildings, not as much in Sunnyside, but more in Long Island City and Astoria, that were, doorman elevator buildings at a higher price point. And then you had your, kind of one-off renovated walk-up buildings that, were nice, but just not done to the level that we thought was appropriate. And they weren't done, on scale institutionally. So, we came in, rebranded these buildings, gave them building names, because Queens addresses are just honestly just so hard to remember, and completely got renovated the asset, everything from the intercom system to redoing the hallways, new tiling, new painting, incorporating artwork, new stair treads, fully gutting the apartments down to the studs, upgrading base building systems, electric, plumbing, washer and dryer in units, split systems in every room, and very high-end finishes in the kitchens and bathrooms, and creating a product that never really existed in Queens. And that led to a lot of our success in those submarkets. We ended up doing roughly a little bit over 30 deals in Sunnyside, Astoria, and Long Island City. And that really expanded onto other markets as we, really developed a great ability to renovate buildings and reposition them. We always had a great ability to source these off-market, kind of under-marketed deals. But once we built like the real construction kind of machine, that allowed us to go to the next level. And, now we have 59 assets. We're very active in Greenpoint and Williamsburg. We actually moved our office here. I personally live here, and we are now really focusing on those submarkets, and that's really how we ended up at 799 Manhattan Avenue. Greenpoint is a market that we're really excited about and see a lot of opportunity.
Gotcha. Yeah, and it seems that y'all we did several case studies when we were doing our underwriting and saw some of your experience. David, I mean, how many of these transactions have you done in New York and then specifically in the Brooklyn area?
Yeah, so to date, we completed 59 buildings. The majority of the buildings range from 6 to 50 unit buildings. We've got a couple of 50 unit buildings. Our portfolio is about 600 apartments to date. And in Greenpoint, Brooklyn, we've developed approximately about 150 or so apartments. We started in the Greenpoint market about a year and a half or so ago. With the purchase of a 972 Manhattan, which is a corner asset on Manhattan and India. Renovated that, had great success there, saw great upside in rents. The market received our product very well, and we just continue to expand in that market like we had done in Sunnyside and Astoria and in Long Island City. So we just repeated what we were doing in Queens and Brooklyn, and it's been very well received. And we've continued to grow. Is our most recent acquisition, and we have currently 2 projects that are ongoing in Greenpoint, 3 projects, 2 of which are completed and now being marketed for lease, when one of them already being fully leased in the last 3 weeks, and one we just started construction on today, just a few blocks away at 880 Manhattan.
Did not realize that y'all had so much direct experience in Greenpoint neighborhood. What about Greenpoint is so attractive to you? What about this market has been such a driver of what you see as success?
I think it's just a natural extension from Williamsburg, and there's significant development going along the waterfront, which really started with Brookfield. And a rezoning along the waterfront, and that really continued up from Williamsburg, and it's really just become a neighborhood of creatives and young professionals that young people want to be, both to eat, both to go out. Greenpoint historically, was really challenged by the public transportation. That certainly has improved with the ferry system, and the interconnectivity of the G train, and it's also changed a lot from COVID. It's not the same as it was pre-COVID, where everybody needed to go to the office 5 days a week and commute to Manhattan. I think that's become a lot less important. And, there's really become an ecosystem in Greenpoint where people live, work, and spend their whole day in Greenpoint and not really commuting to Manhattan as much, especially, as things like video conferences like this become more prevalent, and there's less of a need for people to be in the office every day. So we just really love that market because there's a ton of demand for young professionals to be there and hang out every day. And that's really where we've seen an ability to drive rents. And Manhattan Avenue in particular, we're very bullish on because, you have all this development along the waterfront on West Street and Franklin. And all these people, if they're commuting anywhere, whether it's into central Brooklyn or commuting to Manhattan, and they have to go to Manhattan Avenue where either, the Greenpoint Avenue or Nassau stop is. And I think, over time, that's really going to benefit the retail. And I think we'll see significant rent growth from that.
Just to piggyback on that, I think that what we've seen over time is just every single neighborhood along the waterfront that has views and that has proximity to Manhattan has just grown immensely. We've seen it, in Williamsburg. We've seen it in Long Island City, where they have, 55,000 new units. We've seen it in Astoria, and even on the other side of Manhattan, in Jersey. We've seen tremendous growth in Jersey City. We've seen tremendous growth in Hoboken. So, Greenpoint is really just another, extension of Williamsburg, where we've seen tremendous demographic changes and shifts that have really pointed towards growth. And just that sort of proximity to Manhattan has really helped drive that growth. So we're sort of at the cross points between Williamsburg and Long Island City, and it's just a natural infill between those two, high growth neighborhoods.
Really attractive, yeah. The ferry and the transit system obviously are the lifeblood of New York City, so that access has to be definitely a key driver for real estate around there. But let's get into maybe the asset itself, the property itself, and your business plan. Can you tell me about the building, how you acquired it, and what makes it an attractive asset to you?
Yeah, so the building was acquired off market through IPRG, which we were a likely buyer for. We buy a lot of vacant sub rehabs. We have a great ability to renovate, and we'd like to really, we want to improve the neighborhood and create great housing. And this building in particular, it was owned by two women. For several years, the building hadn't been renovated in over 30 to 40 years. The residential entrance was literally didn't have an entrance. That's how deferred the maintenance was here. So, we came in with the vision of gut renovating this asset and creating, a peak standard here. And it was the perfect candidate to come in and really give it a new facelift. And we just really, what we liked about the opportunity, was location, Collier in Manhattan, very high foot traffic, great location in Greenpoint, very close to a lot of the great restaurants like Oxomoco and several of the other great ones in Greenpoint. And this was the perfect renovation candidate, just given that, it hadn't been renovated in 30, 40 years and was a vacant blank canvas. And the building just also had, really good bones, brick building, high ceilings throughout, good light and air, all those things attracted us to the building.
One of the things that I also is important to know with this particular asset is that it sits in a landmarked area in Greenpoint, which obviously it's recognized by the city as having historical importance. The building is in a landmark district, and although if you see a picture of it today, it doesn't seem like it's really architecturally significant in any way. It's because of just all of the years of negligence and having a dollar store occupy the retail for 20 years or so. It wasn't really cared for, and that's something that excites us about the building and about Greenpoint as well, is the fact that we're very design centric firm, and so we'll be able to really make it shine as it once did. So I think that's a really nice part that the city recognizes Manhattan Avenue and certain areas of Greenpoint as landmarked.
The other thing worth mentioning is it has a favorable tax class. So, the tax increases are capped on growth. And, we can add a lot of value here, get great rents, which allows us to, push NOI significantly, but still maintain that kind of yield because, we have tax protection.
And just to expand on kind of what that means for investors that are outside New York that don't understand. So in New York, we have assets that are under 10 units are tax class protected, meaning they're capped as far as how much the real estate taxes can increase. So obviously, while we boost the NOI, our taxes remain relatively the same. So that's something that attracts us about these smaller assets.
Yeah, they're capped at 8% on a single year and 6% on average every 5 years, versus a tax class 2 building, which is greater than 10 units, is based on income. So, the problem with a lot of deals in New York City is you add a tremendous amount of value by renovating, but your taxes increases erode a lot of the value that you've created.
There's obviously mixed use in this building. You've got the residential and you've got a commercial downstairs. How does that change anything about your approach on this particular asset? And how do you think that might benefit the asset overall?
Yeah, I see it as a benefit because to Alex's point earlier about there being just great potential along the Manhattan Avenue corridor is the main retail corridor for Greenpoint. So that's where that's where the national retailers are. Just a few blocks, you have McDonald's, you've got the Starbucks, Chase, all the nationals are within walking distance of Manhattan Avenue. So where we've seen a lot of growth in rents in the last 12 to 24 months in Greenpoint. Once a lot of ground up developments that are scheduled to be completed in the next, 12 to 24 months is going to see density grow. And obviously there's going to be a lot of potential growth for the retail portion of Greenpoint. So that's something that we just particularly find very attractive versus, smaller growth in the residential component of the building.
I think it's all about being conservative and just underwriting, reasonable retail rents. And what attracted us to this location, versus others is, when you're talking about, under $100 a foot and in that, $100 range, it's a very palpable rent for a tenant that could get, great access to a ton of foot traffic on Manhattan Avenue and this young population. Which felt very comfortable to us. And a lot of the uses here are going to be neighborhood uses, whether it's a restaurant, nail salon, you pick it. We think it's stuff that we feel very comfortable about achieving those rents. We actually just, bought a building probably about, 3 months prior at 880 Manhattan, where we leased it to a physical therapist. Honestly, really before we even closed on the deal. So we think there will be, significant demand for this retail space, and excited to see who's, going to come to the space.
The natural comparison for Greenpoint is Williamsburg. So when you think about Manhattan Avenue and you think about, Williamsburg being, the main Manhattan Avenue is the main retail corridor of Greenpoint, really because it's the only avenue that has the train. So it has the G train right there, which connects Brooklyn to Queens. And when you compare that to Williamsburg, the main corridor is Bedford Avenue. And Bedford Avenue now is just seeing tremendous growth in terms of the retail that's going there. I mean, right off of Bedford, you're now seeing tremendous companies such as Hermes and Chanel, Sephora, that are paying, triple digit, $300 type rents, because it's the main corridor of Williamsburg. And we're kind of seeing that similar type of shift starting to occur in Greenpoint. That's why we're so attracted to Manhattan Avenue, where we have, this is our third asset on Manhattan Avenue, and we're tracking a few more. So we've really seen Manhattan Avenue be equivalent to the Bedford Avenue of Williamsburg, and Franklin Avenue be equivalent to the Berry Street of Williamsburg. And we're really focused in that area between Manhattan Avenue and Franklin Avenue in Greenpoint.
It's playing for a second leg of upside. I mean, you have, kind of the original business plan, and, there's a second, kind of generation of retail pop.
Definitely. And then in terms of specific business plan for this building, are you looking to just renovate the existing units, or are you trying to do more major renovations to convert some of the units to, multiple bedrooms, et cetera?
Yeah, so we're going to be gut renovating the entire building. So the retail unit, we're going to gut renovate it and white box it, so we can start, working on a potential tenant for it. On the apartments upstairs, we will be creating density and creating 2-bedroom apartments. We're currently they're 1-bedroom apartments, so we're going to create better, lay out the apartments better in order to accommodate 2 bedrooms per apartment, potentially 2 bathrooms as well. We're currently working through that.
What do you foresee as the typical tenant that would be renting this type of these types of residential units?
That our typical tenant for the product that we put out, especially in Greenpoint, is that 25 to 40-year-old makes anywhere between 100 to 150,000 dollars per year. A lot of tech, a lot of service industry professionals, accountants, some attorneys as well. Our two bedrooms generally are rented by couples who are moving in from the city who just need an extra bedroom to satisfy their home office needs. So that'll likely be the type of demographic, the type of tenant that we get here at the building.
And then New York, especially being a primary market and multifamily right now, some investors are concerned about overheating. Is there any concern about Greenpoint particularly getting too pricey, or is it right now the perfect time as you're catching the upswing?
I don't think so, because I think there's a huge supply problem. You do have a lot of new ground up development along the water, which certainly will bring a lot of supply, but that's very different product and at a different price point. That's all going to be priced above us. It's all doorman, elevator, high amenities, different type of space. We like to, really present ourselves as affordable luxury. And really what that is you're going to get a very great unit, great experience from the moment you walk, past the front door. You'll get a washer and dryer and high-end finishes, but you're just not going to get the doorman elevator amenity experience. But you'll save, a good amount by having that. And I think, the lack of real quality units in Greenpoint will let us hold rents very well, because there's just really not a lot of competition for the quality that we're going to present. And I think there's people that just want to be in Greenpoint. It's not, just about finding more space and value. It's a place. It's an ecosystem. It's a certain type of life that young, professional, creative people want to be. I mean, it's just a ton of restaurants, bars, and just quality of life in that area that people want to be there and they'll pay to live near there.
Yeah, something else that we've discovered in Greenpoint or across our portfolio as well is that these smaller boutique buildings are very well received by the demographic in the neighborhoods. A lot of young people who lease at our buildings don't want to be in a 200-unit building, as attractive as it may be. They like the boutique feel. They like that artsy kind of old New York walk-up sort of style. So we find that when we combine sort of that walk-up boutique feel with a nice modern condo quality apartment, it just happens to be a really good fit for that demographic.
Yeah, and they say that like you've really made it in New York when you have a washer dryer in your unit. So we kind of stick, about $1,000 a month less than the, elevator amenitized doorman building. But we still have, the interior amenities that tenants in these locations would want, such as, washer dryer in unit, fully gut renovated kitchens and bathrooms. We actually put a TV in every unit that we as the developer pay for ourselves. And it sort of allows people to walk into the unit and recognize that, it's ready for someone to call it their home.
Excellent. Yeah, maybe we can get into some of the technicals of the deal itself. Obviously our investors are coming in for a limited partner equity stake, but how is the rest of the transaction being financed, especially in this high interest rate environment?
We've done this deal. I mean, this is a deal that's going to be fully vacant when we acquire it, which is really important to being able to complete our value add process quickly. I mean, one of our biggest strengths is really our construction side of the business, in that we complete our construction very quickly. And a lot of that is really due to having a rinse and repeat sort of process as it comes to the construction. So we've completed, of our 59 buildings, about 45 fully completed construction jobs. So over those 45, value add projects, we've really honed in and, I don't want to say perfected, but we've gotten really, really good at completing these jobs quickly and completing them well. So in that rinse and repeat, we use the same architect, the same engineer, the same GC, and a lot of the same specs, all the same materials, which allowed us to, take a look at this project and say, we're going to be completing construction in, somewhere between 4 to 6 months. And then following that, work to refinance the existing construction loan that's in place. So we expect to return about, to the bank, we expect to refinance the existing construction loan in probably 8 to 12 months following the value add completion. Right now our loan is $3.75 million with Webster Bank. It's a floating rate loan, but because our construction is going to be done so quickly, we don't expect for potential interest rate hikes to really creep into returns very much. We expect to be out of this loan within the first 8 to 12 months. So, right now we're at about 7.5%. We actually are completing a refinancing right now with Fannie Freddie for for 6 small buildings in the 5.5% range. And this loan actually allows us to convert to a lower rate 5-year permanent loan following the completion of the value add, which wouldn't allow for additional proceeds. So we will go through a marketing process to see at that point in time whether we're able to return cash to our investors. But it at least allows us to conservatively underwrite the deal and conservatively be able to see our interest rate decrease following the completion of the construction and lease up, which should be within the first 8 to 12 months of ownership.
Awesome. Yeah, and as a last point, maybe we can just talk through some of the risks that you might see in this and what the potential mitigants are. So where can this transaction or where can this type of plan go wrong, and where are you guys mitigating those risks along the way?
Yeah, I think the primary risk in development is the actual development of the asset itself. Putting kind of interest rates and the uncertainty of that aside, the beams needing to get replaced. Obviously, until we demolish the interior of the building, we're unsure about the condition of the beams. And the way that we mitigate that is by making sure that we have a good enough contingency to cover, any sort of structural remediation of sistering the beams and that sort of thing, which is just minor structural repairs. So again, nothing that we haven't seen before. So that's how we mitigate around that potential risk.
Yeah, I think it's just conservative. It's all around just conservative underwriting. Whether it's construction and adding contingency or retail. Making sure we have enough time to lease the space and making sure our rents are healthy for what a tenant can be profitable. And I think just running very tight processes that we have to make sure we're doing all the necessary diligence up front, making sure we get the right, third parties to inspect the building and make sure, we're running a very, tight process to get this done efficiently.
And in terms of leasing up the property, any concerns there? New York, obviously a pretty tight residential market, but in general in this market?
Yeah, I think fortunately, for us in Greenpoint and in the last 6 months, we've continuously brought units to market. So starting about 6-7 months ago, we started bringing units to the market, and we've seen just great results and speed with the absorption of these units. Just currently, we own a building that's 2 blocks away on Milton, and 8 units. And within the first week, 4 out of the 8 have already been leased. So the velocity is quite fast. And mind you, we also were able to achieve about 8 to 9% above what we underwrote. So very excited about finishing this product. Like I said, the good thing in Greenpoint right now is that we have a lot of markets entering the market. So we're seeing in real time how quickly these units are being absorbed and how much we're able to push rents based on availability.
Yeah, we 94 Milton is the asset that David's talking about. It's a 2-bedroom, 2-bathroom unit that that's the data set there, which is exactly what we're doing here. We're doing 2-bedroom, 2-bathroom. So we hit $5,300 a month on the final units there, which is a number that, quite honestly is much more than we underwrote. We underwrote $4,750 there. So we hit it out of the park on that deal. Here we've similarly underwrote $4,600 to $4,700 rents for the units. I see no reason why we can't hit very good rents here too. They're going to be similar units, both 2-bedroom, 2-bath. They're going to be railroad style apartments, similar to 94 Milton. So we're really excited to start the lease up process. And then with the retail, like Alex mentioned earlier, we leased to a physical therapist about 3 blocks away at 880 Manhattan Avenue. We actually had 2 tenants that were fighting over that space. The other tenant was a coffee shop. So we feel very confident in our ability to lease the retail. Both of them were at the rents that we needed to hit. So we feel good about our prospects on the leasing side and think that our underwriting was relatively conservative.
Yeah, I think just because we have a huge sample set in Greenpoint, we have direct comps. It's not going to get the same rents as 94 Milton because that's a superior block, and on Franklin, which prices at a premium to Manhattan Avenue. But, we know the market by having, 10 or 11 buildings in the submarket. We see where, these rents are being priced, and that allows us to go into these deals and underwrite them very comfortably.
Yeah, one of the positives as well is that we'll be done with construction here if everything goes according to plan this summer. And obviously during the summer will be a much more attractive leasing season than end of winter. / early spring. So that's one of the reasons that we're going to push to get this project done as quickly as possible. Because obviously if we can hit, the July, August leasing months, then we should expect to do very well.
Yeah, those are really interesting points to bring up about the market. And just would like to ask if there's any other highlights about this transaction or that deal that you're really excited about.
Look, I think, this for us is a typical perfect peak transaction. We bought the deal very well off market. It was the profile of a seller that we like to buy from, long-term owned, hasn't been renovated in 30, 40 years. A lot of value to be added, tax class protected, fully vacant, which allows us to come in and gut renovate from day one. Very prime location, a couple blocks from the G train on Manhattan Avenue on Colliers, which is a great block. And it's a great quality building, high ceiling heights, architecturally significant. And, we think these are going to be great apartments and a great asset that we're going to be able to, execute the business plan very quickly.
Yeah, the one thing that I'm particularly very excited about is just the market itself in Greenpoint as sort of being the development operating partner at peak. I spend a lot of time on the ground and seeing the change that I've seen happen in the last 12 months in Greenpoint. It's very exciting to see the vibrancy of that neighborhood. I spend my weekends going there with my family, spending a lot of time in the area. So I'm very excited about the growth of Greenpoint. I'm very excited about the potential growth that's sure to come to Greenpoint in the next few years as density happens, as growth happens, as more retailers, more national retailers, restaurants continue to come to the area.
Yeah, and I remember learning two things about investing in real estate. Number one is to buy the worst building on the best block. Here we have a 99-cent store with 3 floors above it that have not been occupied for over 30 years. We have an opportunity to really gut renovate an asset that has been in the wrong position for an extended period of time on a really strong block on Manhattan and Collier. And then number two is to follow the money. And we've seen just so much investment in Greenpoint by companies like Brookfield, Westfield along the waterfront. And I think that we're going to continue to see tremendous investment in the immediate neighborhood. So by investing, in a building that has tremendous upside, given that it was a 99-cent store on a great block, I think that we really have an opportunity. I'll also just mention one other thing, which is that when we were putting down our hard deposit on this deal, we were about to sign it up and put down our deposit at $4 million. We huddled up internally and said, there's a lot going on in the market right now. Things are starting to feel like we can really hold the seller's feet to the fire. So we put a deposit down and signed the contract at $3.7 million, which was, where the seller ended up countersigning. But we did not expect necessarily for them to countersign at that price. We were excited and surprised when the seller did agree to this price. And we were ready to do the deal at $4 million. So I think that speaks to the discount that we received, which is about an additional 10%, which, for these smaller deals really goes a long way. And we're just excited to add another great building to the neighborhood.
Awesome. Well, really happy that you all could join us today. Alex, David, and Alex Heskel, thank you again for joining us. Investors, if you have any questions, you can always contact us at ir@equitymultiple.com. Once again, really happy that you joined us, and happy investing.